start the recording. Good morning, restaurant owners. Welcome to this week's live Facebook training dedicated to restaurant owners, helping you understand your finance and accounting and how to use that to improve profits and cash flow. I'm going to share my screen and we will get started with this week's presentation. And this week we are on restaurant tax strategies that keep more money in your pocket. We're also going to go over the One Big Beautiful Bill Act, key provisions that restaurant owners can take advantage of. And this is these are practical legal tax strategies designed specifically for restaurant owners to maximize profits and minimize your tax burden legally. Every dollar saved in taxes is a dollar for your business. The hard truth is most independent restaurant owners overpay taxes every year, missing out on thousands of potential tax savings that could be reinvested in the business or taken out of the business into your pocket. In the next 15 minutes, we're going to go over the most effective tax strategies to significantly reduce your tax bill with benefits you can implement starting this year. It's not too late to implement some of these things. These strategies aren't theoretical, they're practical solutions specifically designed for restaurant operations and workflows. Now, I am a CPA. I did have a tax practice for almost 30 years. I sold that practice a few years ago. My firm, Financial Optics, we don't actually prepare tax returns. However, we do work very closely with our client CPAs to make sure they're taking advantage of all the tax strategies that they can. And if we onboard a new client and they're not happy with their current tax CPA, we have a sister firm that we refer out to, and we work very closely with them as well. So let's get into this. What are the common costly tax mistakes restaurant owners make? Number one is blurring your personal and business expenses. Now, most of you have, or I hope you have, business bank accounts, business credit card accounts, but there are times most of our clients, if they're out and about running errands, they'll dip into their personal debit card because they don't have the other bank account, or a personal credit card because they don't have the other credit card to charge and pay for little things, even sometimes bigger things. If they're at an auction buying restaurant equipment, let's not blur those. Make sure you're capturing all those personal expenses. And the best way to do that is to make sure you're using, especially for credit cards, have a single credit card or a separate credit card set up for the business. Poor real-time expense tracking, failing to document deductible costs as they occur. This has more to do with an item that we're going to talk about in a little bit, and that is getting into quarterly planning. If you're doing quarterly planning with your tax CPA, she or he needs to have updated records so they know exactly where you stand as of the end of that quarter. The third thing is overlooking major tax credits, industry-specific credits like the Work Opportunity Tax Credit. We're going to talk a little bit about that. We're not going to get into all the details. It's a little complex, but it's something that most people don't even know about. And your Social Security tax tip credits, which can be a huge deduction. Make sure you're not leaving that money on the table. Unplanned asset purchases. Buying equipment without a depreciation strategy misses opportunities for immediate write-offs. That's more of a timing issue. And as you get close to year end, if you're planning on making equipment purchases, talk to your tax CPA and decide whether or not that's better this year or next year. Delaying that purchase until January of the following year or accelerating those purchases into the current year. The fifth one is treating taxes as annual events, and we already talked about this. That's waiting until tax season instead of implementing year-round tax planning. It can cost you money every quarter. All right, I apologize for this slide. It's a little bit confusing, but let's get into this. Core strategies to reduce your restaurant's tax burden. Number one, this is everything over here. minimizing deductions through proper categorization. It's having good, clean books and making sure whoever your bookkeeper is, whether that's an in-house bookkeeper or an outsourced bookkeeper, making sure they actually have some tax background or some tax understanding to make sure you're categorizing everything correctly. In real time, maintain separate business accounts. We already talked about that. Reimburse yourself for all those personal payments. Don't just take it as have them recorded as a draw. Actually reimburse yourself through an accountable plan. If you don't know what that is, talk to your tax CPA about what an accountable expense plan is. It just keeps it cleaner and survives an audit much easier. Tracking business mileage. When you're out and about on catering, supply runs, going to the bank, whatever the case might be, track that mileage. It can add up over the course of a year. And then distinguishing between ordinary expenses and capital assets. And that's something we have experience with because of my 30 years background as a tax CPA. But it is something that an in-house bookkeeper should recognize. If you're buying kitchen equipment, that's just not in a supplies expense, that's a capital expense. And as those transactions come up, they can go over it with your actual tax CPA. Optimize depreciation and capital expenditures. Leverage Section 179 and bonus depreciation for kitchen equipment in point of sale systems. And then we get into the timing again. Time major purchases to align with cash flow and tax year advantages. So timing of when you purchase, and if you've made a purchase, does it qualify for Section 179, which is first year expensing of a capital asset? And that planning and that decision-making can be done at tax time, even though a purchase was made last year. It's something you should sit down and talk about with your CPA when you're doing your tax return. Are we taking advantage of Section 179? Or if this is the first year of your restaurant or the second year of your restaurant, profits may not be flowing at the highest level that they will be in coming years. You may not want to take advantage of Section 179 this year and delay that depreciation on some kitchen equipment over the next 5 years. So you have that tax deduction advantage when income and profits are a little bit higher. Number 3 is claim all available tax credits. Work opportunity tax credit. That's for hiring for targeted groups. Could be hiring someone whose family is receiving assisted living benefits from the government or veterans. And there's some other targeted groups. It's a little bit complex, but just mention it to your tax CPA and make sure you're familiar with the program so that if that opportunity comes up and you want to take advantage of that tax credit, make sure you're doing it. Energy efficient credits for lighting and HVAC upgrades. That's been updated with this year's big, beautiful tax bill. FICA tip credit for taxes paid on reported tips. Make sure you're taking advantage of that if you're in one of the states where that qualifies. Optimize entity structure. Choose between S Corp, LLC, and C Corp to minimize self-employment taxes. Something that this is usually a decision that's made early, but you can transition if you're currently a C Corp, and it makes sense to transition to an S Corp or an LLC to take advantage of self-employment taxes. And now, more importantly, to take advantage of QBI, qualified business income tax deduction, which we'll talk about in a minute. And that's balancing owner salary with distribution or draws to reduce payroll taxes. That's the minimized self-employment tax. But the entity structure is becoming even a bigger bill with the QBI, qualified business income. Implement owner fringe benefits, establish tax advantage health insurance, retirement plans, and accountable reimbursement plans. We talked about that accountable reimbursement plan. That can even extend to things like a home office. Gets a little tricky, something you want to make sure you're going over with your tax CPA. I'm hoping I'm saying that enough times. But part of what we do as an outsourced accounting firm, Financial Optics, we help you recognize when there might be an opportunity for some of these things, point it out, and make sure that it's being discussed with your tax CPA. And we're actually involved in those discussions with most of our clients. All right, moving on. One Big Beautiful Bill Act. These are some things that were changed in the current year and are effective this year. 100% bonus depreciation. What changed? You can now write off the entire cost of eligible equipment. And we talked about the timing issue there. The expensing, Section 179 first year expensing limits have increased to 2.5 million. And there's a phase out threshold that now starts at 4 million. I doubt most independent restaurant owners are going to get to that, but I wanted to point it out here in the bullet points. Why it matters: accelerated deductions on kitchen equipment, renovations, technology upgrades, freeing up immediate cash flow for growth and debt reduction. The renovations, that's a tricky area. But if you're renovating even your front of house or back of house, some of those things don't need to go into the long-term leasehold improvements category. They can be peeled off as an equipment purchase and expensed in the current year. Those are some things that, again, you want to go over with your tax CPA. $50,000 kitchen upgrade can now generate $10,500 in tax savings. That's assuming a 21% tax rate, and that's a low tax rate, tax bracket. Okay, moving on. QBI, qualified business income deduction, is now permanent, and there's higher thresholds. It's a 20% qualified business income, sometimes labeled as the small business income deduction. It's permanent now, as permanent as tax law can be. That just means it's not being phased out at a designated target year. It's permanent and would actually have to be repealed with a new tax law, which isn't out of the question, but it is permanent. Key changes: the deduction is permanent. Can I say that enough times? Higher income thresholds, 197K for singles and 390K for joint filers. So once you hit that income threshold, the QBI starts to be phased out, but a lot of independent restaurant owners are below that phase out period, so you can take full advantage of it. So a restaurant with 200,000 in qualified business income can deduct 40,000, potentially saving 8,800 in taxes if you're in that 22% tax bracket. And again, that is a lower tax bracket. No tax on tips and overtime relief. That's been highly publicized, and it's effective this year. So what's covered? Workers earning 150K can deduct up to 25K in tips and overtime pay. Applies to servers, bartenders, bussers, and other tipped positions. And it also includes overtime pay for all restaurant staff. So the business impact is your staff can take home more income without changing their payroll costs. And here's a big one that's an impact: is the employer W-2 reporting requirements are effective this year. You need to make sure you're tracking overtime correctly, and you need to make sure that you're tracking tips correctly. Tips are probably automatic for most restaurant owners. You're tracking that correctly if you're working with a reputable payroll company. But make sure that you're working with your payroll company and working with your staff to track overtime correctly, because that now needs to be reported separately on the W-2 and can trigger some great tax deductions for your team. So highlighting that and emphasizing with your team can improve retention and reduce turnover, higher morale and staff satisfaction, more predictable labor costs if you're improving retention. So don't just overlook these advantages to the big beautiful bill because they don't impact you as the owner. Highlight them with your team and make sure they understand it, and it can boost morale. Enhanced deductions for employee benefits, student loan repayment. There's a tax-free benefit for employers with student debt. Employees within student debt, employers can contribute up to $5,250 annually without increasing employees' taxable income. There's boosted childcare benefits. If you're providing employer-provided childcare assistance, paid family leave credits, tax credits for restaurants offering paid family and medical leave. Now, you may not be required to offer these things, and a lot of independent restaurant owners simply don't offer them. But make sure you're aware of them. They may be some things you want to implement to not only reduce your tax burden and they can also become a powerful recruiting and retention tool in a competitive labor market. So they're not cheap to implement, but they may be some things you want to consider if you're trying to retain that top talent. Additional tax benefits for restaurant owners, the SALT deduction increase. Now, this applies mostly to states with really high state and local income tax, California, New York, Illinois. It may apply to you as a restaurant owner. Just make sure that you understand it. You can deduct now up to $40,000. It used to be $10,000 in state and local taxes. It could greatly reduce your individual income tax return tax burden. R&D expensing. This has been enhanced with the current tax bill that was passed this year. There's immediate deduction for domestic research and development activities, including if you're customizing or developing your own point of sale system, if you're developing custom software for your restaurant, custom menu data analytics tools, operational workflow improvements, that one might be a stretch. But any of these things that you're doing, just make sure they're identified and addressed and discussed with your tax professional. Retroactive options apply to expense from previous years. Okay, let's do a high-level review. 100% bonus depreciation, instant write-offs. We talked about the timing involved with that. Enhanced Section 179, that is this larger immediate deductions, and we talked about the timing on that as well. Permanent QBI deduction, sustained 20% pass-through for higher eligibility thresholds. Make sure that you're in the right entity election, S Corp or LLC partnership, to take advantage of those QBI deductions for the income that flows through to your personal tax return. Tip and overtime relief. Employees get more for their earnings. Emphasize that with your team for reducing turnover and improving morale, and especially for retention of employees to stay in the current industry and stay with you so they're not looking at other employment opportunities. Employee benefit credits, tax efficient benefit programs, student loans, childcare. We talked a little bit about that. And R&D expensing, immediate write-off of innovation costs, and effective retroactively for tech investments. What's not listed here is taking advantage of tax credits, the work opportunity tax credit and the TIPS tax credit. Make sure that you're tracking those things on all your Social Security tips that you're paying as an employer and take a credit for that. Combined, these provisions can significantly reduce your restaurant's tax burden, meaning the tax burden through to your personal return, because most independently owned restaurants are an S corporation or an LLC operating as either a partnership or an S corporation. That restaurant profit flows through to your personal tax return. So that should say to reduce your individual tax burden when properly implemented with professional guidance. Forward-thinking moves. Don't wait to act. These are some things you can do now. Accelerated equipment purchases. Front-load planned equipment upgrades now. If you're planning over the next 12 months, maybe you should be looking at implementing those upgrades in the current year so that you get that deduction this year, especially if you're having a very good year. Consider replacing aging equipment, even if it's still functional. the net benefit can be high if you're taking that tax deduction in the current year. Reviewing your entity structure, we talked about that, especially in light of the enhanced QBI benefit, permanent now. Updated payroll systems, make sure you're tracking everything correctly for tip reporting and overtime reporting. Implement new benefit programs. Consider rolling out student loan assistance, enhanced child care benefits. They are now tax advantaged under new provisions. So successful tax planning requires a structured approach, quarterly meetings with your tax professional with updated real-time financial statements for a robust documentation process, and taking advantage of new tax laws or implementing tax advantage systems now instead of waiting to discuss that with your tax professional during tax time next year, and it's too late for the current year. All right, don't just work hard, keep more of what you earn, right? Book your free profits and cash flow analysis. There'll be a comment below this recording that will include a link to my calendar. Book a no obligation review of your current accounting systems and processes to ensure you're capturing every possible tax deduction. We'll also look at your overall financial performance of your restaurant, identify some of your biggest opportunities for improved profit and cash flow, and map a path towards more profit and cash flow. And I'm going to stop sharing that screen, and we will see you next week with the weekly live training. Have a great week.